USA, many countries, they use this IFRS or International Accounting Standard, but within US, there are two exceptions, US and China. US uses their US GAAP and China uses their Chinese GAAP. But outside of this country, most of the countries, they are using international standard, and you probably have heard the term convergence. Right, have you heard the term FASB, FASB? FASB, Financial Accounting Standard Board. We have another institution that's called ISB, International Accounting Standard Board, and the goal for these both parties are to converge or to minimize the gap of these two standards. So it's totally reading based. So I would expect you will read the assigned pages that I already mentioned or your study guide. But I'll focus on a couple of items here because you will have short answers from this chapter. So first, let's think about the accounting diversity. Have you heard the term diversity? What do you mean by diversity? Diversity, the word itself. Anything that comes up in your mind. Different things, right? Diversified, that means different. So now if you think of like accounting standard, you will see that if you see all countries, we are not using the same standards because we have different reasons for using all these different standards. So if you look at a German company's financial statement, they usually revalue all of their fixed assets. Versus if you look at US company, how do we record our fixed assets? You remember historical cost approach? That means we always record our land, building, equipment as per our cost price. But on the other hand, a German company, they will check at the end of the year what is the value of this building, and they're going to revalue all of their assets, long-term assets, and they will report it. So, say for example, one German automobile company versus one US automobile company, they are doing same things. They are qualitatively same in terms of their performance, but just because one company is revaluing their assets at the end of the year, another company is using historical cost, you will see at the end of the year different balance sheet features. Right. So here you will see that different countries are using different type of accounting methods. For example, China, they use the direct method to prepare their statement of cash flows. On the other hand, in USA, we use the indirect method. Right. So here again, I mentioned German's examples. They revalue their balance sheet items. Right. So now, what are the reasons that we see that different countries are using different standards? So you need to know these reasons. It looks a little bit clumsy, but you will have a short question on it. So you don't need to memorize or write like pages after pages, only few bullet points or touch every item. For example, first let's focus on this legal system. Those who are taking business law course, you should be familiar with common law and code law. Right. So you will see that for any country, their accounting standard must be shaped by the legal systems. Right. For example, common law country, mostly like Anglo-Saxon English-speaking countries, their standards are very detailed. On the other hand, code law countries, they don't have that detailed standards. So they have like a bit of flexibility in their laws, and you will see the same reflection in their accounting standards. That means the legal system is the factor that will influence the accounting standard of any country. Financing system. Here in USA, what's the major source of our financing? Think of the public companies. How do they raise their fund? Where do they go to raise their fund? Public companies. Public limited companies. What's the main source of their financing? Shareholders, right? They go to the stock market, right? They list their company, and this is how from the share market they collect their money to run business. So in USA, share market is the main source of financing. But if you look at the Japan's economy, it's not the share market, it's not the stock exchange, it's actually bank-based economy. So usually bank or debt holders are providing their main financing. Some countries, socialist country, government provide the main financing, right? So here you will see if a country like USA, where stock market is the source of your fund, your accounting standards, your laws, your regulations will try to protect the shareholders' interest. Right, if you look at Dodd-Frank, or if you look at SOX, right, Sarbanes-Oxley Act, all these acts, if you look at all accounting accounting standards, they all are trying to protect shareholders' interests. On the other hand, if you look at German or Japan's economy, you will see that they try to protect bank or bondholders' interests. So, what's the main source of financing system of an economy also matters to decide how should be the accounting standards. Like some Asian country, developing country, you will see that most of the big companies are run by like some wealthy, rich families. So they actually influence how the accounting standards will be. So depending on the financial system, your accounting standards can be different. Taxation. Right. So if you need to pay higher tax, like in USA, 30%, 35% corporate tax rate, and that's why you are allowed to prepare 2 sets of financial statements. Right. If you take any corporate tax course, in your MSA program, corporate taxation, you will see that you can prepare 2 sets of financial statements. One is for your shareholders or other external users, another is for your tax authority, IRS, that is allowed in USA. But if you go to a country where the tax rate is very low, you don't need to prepare these 2 different sets. Right. Inflation. So you will see that inflation, high inflationary economy, they usually use historical. High inflationary economy, they usually cannot use historical cost because inflation will change the economy, but historical cost, if they use historical cost approach, that will understate their assets. So their asset valuation will be lower, actually what it should be. Right. So inflation can also influence the accounting standards. So here, if I go back here, you will see the different results here. So we just talked about legal system, taxation, financing system was the source of your finance, inflation. Also, like political and economic ties, right? USA and Mexico, they have some economic ties or trades, and you will see that US can influence to shape Mexican accounting standards. Or like culture, some culture you will see it's male dominated. Some cultures kind of like individualistic. They believe in like individualism, or some cultures they believe in socialism, right? So depending on these cultural systems, I know if you heard these things from any of your management course, Hofstede's individualism, certainty, avoidance, power, distance, masculinity, these are the 4 determinants that actually define how is your culture. So individualism, like in USA, we believe in individualism. If you make profit, it's your profit. You can enjoy it. But if you go to China, if you make profit, it's country. The owner is the country. You have to give everything to the government, and then government will share equally, like socialist or communist countries. Uncertainty avoidance. Some countries, nation, you will see, in some culture, they try to avoid uncertainty. Some cultures, they try to accept uncertainty. Power distance. In some culture, like in Asian culture, there's a huge distance, power distance. You cannot imagine that you will talk to your boss like in one way. But here in the USA, you can express your opinion. You will see little power gap between the boss, subordinate, or superordinate. Masculinity. Some countries are male dominated. Some cultures, you will see female has little power, less education, less quality. So that means depending on this culture or these political economic ties or legal system, taxation, financing system, or all these reasons will define your accounting diversity. So you will have a short question. So as long as I will see these 6 bullet points and at least 1 sentence, for each bullet point, you should be 5. So you need to know these are the reasons. Now, what do you think? If we see that we have different countries, they are using different accounting methods, is it good or bad? What do you think? What are the advantages or disadvantages? You see that German companies, they are revaluing their assets at the end of the year. On the other hand, USA, they are following historical cost approach. So if you see that different countries are using different accounting methods, do you see, is it fine or it creates any problem? Yeah, actually,
it's a good amount of problem.
It's a good amount of problem. Why?
With the idea of reevaluating accounts in America, we really can't do that. We would have such a level of inflation.
Right. Sometimes it's hard to revalue every item, right?
But mean, if you look at that from the other perspective, there might be a country that is maybe more behind, and this can help kind of balance everything out.
Right, that will give little flexibility to balance or to sort out other items. Yeah, so that means Ashley thinks that would be problematic. So do you think if you have different accounting standards all over the world, is it problematic or it's fine? How about comparison? Guys, come on, pay your attention. How about comparison? If different countries are using different methods, like, right, you are an investor, you want to buy some automobile stocks, and you see German auto company, they have their balance sheet, you want to do some ratio analysis, and you have US company. But one is based on their revalued numbers, one is based on historical cost average. Can you compare one German company's financial statement versus US company? I know you cannot, right? So if Chinese company follows their GAAP, and if you pick a Chinese company, it will be difficult for you to compare the Chinese company's performance with a country that is using a different standard. So one problem caused by this diversity is comparability. Right, if different countries are using different standards, it will be difficult to compare. But now everything is globalized. It's not you can think only within USA. You have to think outside of your country. So the main problem is comparison. It will be really very difficult. So if you need to invest, the other countries need to convert their financial statement into US GAAP. For example, if you want to know how this German company is doing, then you need to convert their financial statement into US dollar or US GAAP method. Then you can tell about their performance. On the other hand, if you need to get access to foreign market, right, then you definitely need to convert your financial statements. For example, Alibaba. Are you familiar with this company? This is a retailer, Chinese company. When they are listed here, they have to use what? US GAAP. But in China, they use Chinese GAAP. So it's an expense for them, right? Just because they want to get access to US capital market, they have to prepare another set of financial statement which US investors will understand. Right. What would the whole world will use one standard? They don't need to worry about that. So this type of problem will make it expensive for the companies, right? So there are several problems that could happen because of these diversified accounting standards. Right. One major problem is your comparison. Another problem is to convert your standards into other standard. It is costly. Another problem to get access to the capital market. So if you read it, then you'll figure it out. So you may have multiple choice or short answers on this. Now, here, how about we think of one common standard for the whole world? Right. Can we imagine? Well, that we actually tried, but later we realized that it's not possible because different countries have different economic status, political status, or legal system, or taxation, or cultural system. So you really cannot expect one standard for all. But still, we can try to minimize the gap. And this process is called harmonization. So what happened here in 1987, one international authority was created. This is called IOSCO, and since 2001 they are known as IASB. It's International Accounting Standard Board, like FASB, FASB in USA, and this is the international authority, IASB. They create International Accounting Standard, or IAS, like US GAAP. So since 2011, IASB, they are actually creating all these accounting standards. So you will see a little bit of history. So don't worry to memorize every detail, but you should have some idea whatever I put on your PowerPoint slides, because it will be some multiple choice questions. So you really need to know everything on your slides, right? So here, just remember, IASB, FASB, they don't have any enforcement authority. They cannot judge whether Apple, Microsoft, or IBM, they are following the GAAP or they are following the international standards. The enforcement authority is up to SEC or Security Exchange Commissions, but they just prepare the standard. Okay, so IASC, this is the first organization that was established in 1973. Since 2001, we know this. IASB. So they are preparing these international standards. This is called IFRS or IASB GAAP. It's just like US GAAP. What FASB does within USA, IASB does it for outside USA. And they, again, like FASB, they don't have any enforcement authority. So now what they did, these IOSCO and then several stock exchange, they actually took the initiative. First in 1993, they said that, you know what, different countries are using different standards. It's getting difficult, especially for investors' perspective. Let's take some initiatives and let's make an agreement how we could make these comparisons or cross-border investments, cross-border listing better or more convenient for all those companies. Say, for example, a Chinese company wants to be listed in USA. How could we make this system better or easier? So they signed first agreement, and then later they actually worked with FASB to do one agreement, and that is known as Norwalk Agreement. We'll see in a minute. Bless you. What I mentioned here, IASB, it is actually kind of succeeded in IASC since 2001, and they are creating all these standards. Now, here all these accounting standards are known as IFRS. IFRS is just what in USA we call GAAP, US GAAP, and all these international standards are known as IFRS, International Financial Reporting Standards, right? So these could be the standards issued by IASB, or these could be they took some standards that are already issued before 2001 by their previous organization, IASC, or these could be any type of interpretation provided by IASB or any committee, a part of the committee of these organizations. So just try to understand or at least know these abbreviations, IFRS. And of course, whatever you will see on these PowerPoint slides. So I know it's very detailed. You don't need to memorize all these things, how many acts and how many actually standards they made it, but try to get some idea. Right, so here, again, I'm repeating, since they were incepted in 1973, some key dates, and they started issuing the standards since 1975. The first authority, international authority, is IASC, and they issued 41 standards during this period, 75 to 2001. So since 2001, they changed their name. Now it's called an IASB, and this is the latest I found from the textbook. Until 2016, they made another 16 new standards. Right. So now what happened here, you will see, if you look at the outside of USA, 139 countries are using this standard. IASB or IASC, whatever, before 2001, that was the name. Now, 139 countries are using these international standards or IFRS. Again, it's an old, that's the latest I found from the textbook, but definitely a few other countries, they adopted IFRS. So, how could you make a standard for your country's standard? Either you could make it required. Right, so 92 countries, they made it required. Some countries, 28 countries, especially European Union countries, they said you must need to prepare your financial statements following these IFRS. They don't, EU countries, they don't allow other standards. But some countries, they allow both. You can also use IFRS or you can use their local GAAP. Right. Only two deep exceptions is US and China. So for US and China, you must need to use your own GAAP. So in USA, all US companies must need to use US GAAP. But foreign companies listed in USA, they can use IFRS. But US is not allowing US companies to use IFRS. But now we will check how you could adopt IFRS, especially the countries outside USA. So you see 92 countries, EU made it required. So usually they have a comparative period. So if they want to start using IFRS, Let's pick a country, Mexico. They did it sometime back in early 2000s, right? So what did they do? They first need to select a date. From this date, I will be using IFRS, right? But before that, at least 1 year, they made to prepare 2 sets of financial statements for investors' comparison. That is called a comparative period. So if they decide that during this 2019, I will use completely IFRS, but 1 year before that, they have to prepare 2 sets just for comparative perspectives. Now, how you could make IFRS as your international standard? Either your government can make it required, like EU countries did, or you could kind of replace, or you could allow. That means it's kind of optional. If any company wants to use it, you could, right? So there are several ways how actually your country can select IFRS, either adopt it as a national GAAP or make it required, or you can allow it. Allow means you could use either your own GAAP or you could use IFRS. It's optional. Now I'm talking about the main part, that's the convergence. So these two boards, FASB and IASB, US board and International board, they signed an agreement. Here, FASB's headquarters is in Norwalk. In 2002, they signed a memorandum, MOU, Memorandum on Understanding, and it's known as Norwalk Agreement. And they say that, we need to come up with one standard. Well, it's not possible one unique standard for every country, but we need to minimize the gap, harmonize it. Okay, so how you could do it? Either these two boards can jointly make one standard, or US can accept one IFRS, or international body can accept one US GAAP, right? This is how they can minimize the gap. Remember, the harmonization process or the convergence process, if you heard it, it's not like you will make one unique standard. You need to minimize the gap between these two standards, right? So then in 2006, first here in 2002, they did this agreement, and in 2006, they signed this MOU, and they say that we need to, again, either USA will accept some of the international standards, International Authority or ISB will accept some US GAAP, or they two boards jointly will develop new standards, right? That means it could be kind of two parties involvement, right? So here, Norwalk Agreement again, FASB, they can adopt an existing ISB. FASB means USA. USA can accept ISB's standard, or ISB can adopt or accept FASB's standard, or the two parties can work together to develop a new standard, right? It should be two parties mutual understanding, right? One party cannot dominate the whole process. That was the main theme of this Norwalk Agreement. And then until 2013, the two boards were really successful, FASB and ISB, and these are the areas they actually made changes. Again, either USA accepted international standard, or ISB or International Authority accepted US GAAP, or these two boards work together and come up with a new standard. So these are the areas. Before that, before 2001 or 2002, there were huge differences in all these areas. So they successfully resolved these gaps, and they come up with kind of similar type of standards. Maybe not every case is unique, but similar type of standards. Then in 2008, SEC says that, USA will allow US companies to use IFRS, and they made the deadline. Then again, US was a little bit reluctant. They actually pushed it, the deadline. They say in 2008, they said that, well, by 2014, US companies should be fine to use IFRS. Then SEC actually pushed it. Again, still, until today, SEC does not allow any US company to follow IFRS. But now this is the question, whether this convergence will be successful or not. Although you see that many areas, they successfully worked on these areas, but still, still there are huge differences. And this is the list I'm providing you. This is from your textbook, Exhibit 11.8. I know it's a long list, but I will highlight some items. You need to know the difference. You need to know the difference, make some flashcard or try to remember, memorize all these things, and you will have multiple choice questions. I'll not give you this sheet. Okay, you need to, I know it's a long list, but I will narrow it down. So now what I was talking about, that these are the areas, both boards, FASB and ISB, they are successful, right, to minimize the gap or some sort of convergence actually happens. But you see these 2 pages list, these are the areas the 2 boards are still struggling and working on reducing the gap. So I will take you to this exhibit. I didn't put it on PowerPoint slides because it's a long, just to fit it in 1 or 2 slides. So I'll go over that. But before that, if you compare these 2 standards, what are the main area of differences? First, the difference can occur in terms of recognition versus presentation. Do you know the term recognition? Remember, whenever you will see the term recognize, that means you need to do the journal entry. Journal entry. And if you do the journal entry, then it will affect your financial statements, income statements and balance sheet. On the other hand, another is disclosures. Disclosures means you don't need to record it, recognize it. That means you don't need to do the journal entry, but you have to disclose it as a footnote. Now we have different type of debates between the two boards, especially all these areas, what to recognize or what to disclose. Right. Again, here you will see presentations, presentations and measurements. So again, if you 2 boards are struggling to resolve all these gaps, how you need to present it, an item, or how you need to measure it. So for example, building. Do you need to record the building as per the purchase price? US GAAP says yes, we'll follow the historical cost. But IFRS says no, you need to value the building at the end of the year and report it as per the latest value. So so these are the reasons why you will still find differences, right? Especially for disclosures, extraordinary item or discontinued operation, whether you need to recognize it or disclose it, how you have to present it, right? Or measurement, fixed assets, inventory, should we report it as per the cost price or net realizable value or market value? Fixed asset, I mentioned it. IFRS believes in revaluation, but US believes for fixed asset, record it as per the historical cost or the purchase price. Now, here, this is the summary of the exhibits that I gave it to you, but I'll go over that and I'll highlight the items that you need to know. So I'm skipping these slides, but I'll show you here. So now here, overall, if you see that the main reason here, GAAP always emphasizes on more details, and it's kind of rules-based. So you have to follow the rules. Say, for example, cutoff point. GAAP believes in certain cutoff point, right? Whether you will consider something as a capital lease or operating lease, you need to follow certain threshold. But on the other hand, IFRS, this is principle-based. So principle-based means that you have to apply your judgment. And based on your judgment, your principle, you will decide, you yourself will decide how you're going to record it. Right, so in one sense, you will see that rules-based, there is a debate whether rules-based influence the managers to manipulate the numbers versus the principle-based, right, influence the managers to manipulate the numbers. For example, historical cost approach. US GAAP says you will record the building, whatever the purchase price you pay. That's the rules, right? But IFRS says, okay, apply your judgment. What should be the actual value today? And revalue the building and record it. Now, whether managers will have options to manipulate the numbers, that's another long debate. So here now, what we're going to do, we will focus on these exhibits. And these pages, I actually gave it to you, but I'll go over few few differences, and we'll practice only a couple of number-based problems, right, that you'll have on your exam. So I know it's a long list, but I'll highlight only few. So if you have a highlighter or a pen or marker, so please mark it. And you need to remember, especially for some multiple choice questions. So here, inventory. This is really important. FIFO and LIFO. Have you heard this term? You all should write first in, first out, last in, first out. So here, IFRS, LIFO is not allowed. US GAAP, LIFO is allowed. How you record your inventory? It's only the recording purposes, right? No matter what the physical flow. So last, whatever the inventory you brought last, you will sell it first. IFRS does not allow LIFO method. You must need to follow FIFO. US GAAP says you can use weighted average, LIFO, FIFO, or specific items. Now, here, write down. So, if you need to write down any inventory, IFRS says yes, if certain criteria is written, then you can reverse the write down. So usually, you know what, we always follow, no matter it's GAAP or IFRS, we follow the conservative accounting. So if your inventory values go down, right, I described this LCM, lower of cost or market, or net realizable value. We usually write down the inventory value. But what if, can we reverse it? If inventory value goes up, can we show higher value? IFRS says yes, if certain criteria are met, you can do the reverse of your write down. But GAAP does not allow it. Now here, plant, property, and equipment we just discussed, and that's a very big debate between the two boards, whether you're going to follow the revalued amount or you're going to follow the historical cost. US follows the historical cost. For several items, IFRS says you can revalue it. These are for fixed asset or plant, property, equipment. Right. US, remember, we always follow historical cost, the purchase price. But IFRS says you can revalue certain fixed asset item. Right. And then here, component depreciation, and that's a math problem. We will do it. Say, for example, you have a huge asset. Say, for example, you have a submarine, and you have different parts of it. Or let's make it better, you have an aircraft. So you have different components. Say, for example, the exterior, you could use it for certain years, interior, or the engines. So you have different components, different values, different lives. Now, can you do component depreciation? That means for the different parts of your assets, can you do different depreciation methods? That we call component depreciation. Right. Here, US says, okay, you can use it, it's permitted, but usually we don't do the component depreciation in USA. IFRS says if you have an asset that has different components and different lives, it is required to use the component depreciation. Right. So we'll see one problem. So this one we will have a problem, number problems that I'll have to do. Now another item, R&D, research and development. So whatever you spend for your R&D, in USA you have to show that as an expense, except for some computer software related item. So in USA usually we use, especially if you think of a pharmaceutical company, they invest like millions of dollars for R&D. But we show it in USA as an expense, except for some software. All of your R&D, all types of R&D will be expensed immediately. But you know that's a huge amount that can affect for a certain quarter or year net income. But IFRS says you have certain criteria. Again, it's principle based. If you apply your judgment, whatever your principle tells you, if certain criteria are met, you can capitalize it. So you know the difference between expense and capitalization. Capitalize means whether you can show it as an asset. Right, so if you replace a part of your assets, right? Whether you can show it as an asset or just as an expense. So if certain criteria are met, then IFRS says you can capitalize or show it as an asset. Again, we will have here one problem. We will do it. But US GAAP says you have to show it as an expense unless for a specific software related item. Now leases, that's again another ongoing debate, right? So here they say that IFRS, all types of leases will be listed as your capital lease. So you know capital lease, that creates a liability, right? That must affect on your balance sheet. But on the other hand, here in USA, you could classify it as capital, or we call it like finance, or operating lease. So you know operating lease, when you treat any item as operating lease, right, it's just a kind of a renting type of things, right? So if you are getting a truck, whether you will define this contract is an operating lease. So the truck every month you will show it as a rent expense, truck operating lease expense. But if you want to show it as a financing or capital lease, then it will appear on your balance sheet. You have to recognize as a liability to a lease liability. So here US actually has these classifications, right? So if you define as an operating lease, of course it will appear in your income statement, but it will not affect your balance sheet item. So you have this flexibility. Operating lease, you can avoid recognizing the asset and liability, right? But here IFRS says you must need to show all as an operating lease. Capital lease. Now here convertible debt. Convertible debt means some debts, bonds or debt, you can convert it into equity, right? So here, if you have this type of convertible debt, IFRS allows that you can split it into two parts. The portion that will be converted into equity, you could split it up. A part is a debt, another part is equity. But here, US GAAP says you need to treat it as a debt. No matter if you convert it in 6 months or 1 year, it will be treated as a debt. Now here, preferred shares, right? So preferred stocks, you are familiar with these preferred stocks, These type of stocks are given to some like founder or board executives or some special type of stockholders, and they get some preferences in terms of dividends. So preferred stockholders, usually they have fixed dividend rate and they will first get the dividend. Then if anything remaining, the common stockholders will get it. So here IFRS says preferred stock you have to treat as a liability. US GAAP says preferred stock you have to show under the stockholders' equity. Right, so this is another difference. And last but not the least, here two items. We learned a little bit interim reporting. Right, we did it. So under IFRS, interim period or quarters are treated as discrete accounting period. On the other hand, in US GAAP, we follow the integral approach. So you knew it, right? This interim reporting. Now, last item, statement of cash flow. You probably did it in your intermediate accounting or financial accounting. Interest. So remember how interest is created. Interest, if you take loan, if you borrow, you have to pay interest. That means it's an expense, interest expense. On the other hand, if you invest in other companies' bond, if you invest in municipal bond, government bond, other companies' bond, you will receive interest. That's your interest revenue. Now, when you're gonna do the cash flow statement, you remember we had 3 parts: operating, financing, and investing. So this interest item is another debate. Sometimes the amount is not very small. So here, US GAAP says interest, no matter you paid or received, you have to show it under the operating part. But now, IFRS says when you pay interest, why you are paying interest? This is just because of a loan. Because you borrowed, that's why you are paying interest. So these expenses related to your financing. So So it should not be considered as an operating. So that's why the said is up to you. Either for interest payment, you can call it as an operating or financing. Because you pay interest, you finance through the loan or bond. On the other hand, interest received. When do you receive interest? If you purchase municipal bond or government bond or other company's bond. So this income is not your operating income. This interest revenue is an income, but this is from your investment. So again, IFRS is kind of flexible. They said either it's up to you, either you could show it as an operating or investing activity. So these are the items that I highlighted. You will have multiple choice questions. And two items that I started here, I put a star mark. So we have two short problems. Because I really love to do some calculation and number. And it's actually good for you too. So now we're going to do one problem related to component depreciation and another problem related to R&D. And that will be on your exam too. So I'm passing some exercise problems from chapter 11.